Hi everyone, I'm going to start a new lecture series which is comprised of 5 parts on the topic of real option analysis or real option valuation. I'll teach you how to apply option valuation techniques to capital budgeting decisions. I will cover the relevant topics in these 5 parts, and in this first part I'll give you the introduction of real options and real option analysis. In this 5 parts real option analysis lecture series, we'll be covering learning objectives that include recognizing the value of flexibility in the investment decision of a firm and indicating the different types of options that are embedded in a particular project of a firm. And we will be able to describe, based on the kind of firm and business environment is, what sort of real options could be advantageous. We'll also look into the option pricing models, and the most promising one which would be discussed is the Black-Scholes option pricing model. We apply this basic option pricing model to value 3 kinds of real options, that are option to expand, timing option, and option to abandon. Lastly, we look into the limitations and critiques undermining real option analysis, and definitely we learn to defend our position. First, discuss the basic terminologies which we must know before we proceed with the rest of the lecture. DCF. Stands for discounting cash flows, the traditional way of analyzing investment decisions, especially the NPV method, which you have learned from the basic business finance papers. It helps to determine how much an investment is worth by estimating the future sum of the future discounted cash flows, or we may say finding present value of expected future cash flows discounted a certain discount rate. Second one, options. Options, these are the financial instruments that are derivatives. They are based on the value of underlying securities such as stocks. Options are rights, not obligation to some particular actions in the future. Real options, options on real assets. Similar to options, it's a right for a firm to make adjustment on its investment in real non-financial assets after the projects are undertaken or initially evaluated. It is a choice made available to CEOs, managers, letting companies business investment opportunities that are sometimes uncertain. Real option analysis, it is a dynamic approach to valuation in terms of flexibility and growth opportunities. It is an extension of financial option theory, the extension to traditional DCF method, which includes in its analysis the flexibility nature of investment decision by a firm. It is really certain that some questions will arise in your mind, that what is wrong with the traditional DCF. Answer could be that traditional DCF does not have flexibility. Essentially, it assumes that managers are passive or mechanical in making investment decisions of their firm. Once the project is undertaken or evaluated, that is the end of the verdict. We will stick to that information or action forever. The truth is, things can change during the life of a project. Plus, there could be more to project that meet the traditional NPVs. And actually, managers have right to do something about changes. They have real options. Second question, obviously, when we're talking about value of flexibility, what is the value of flexibility of a project? It is basically a collection of real options that can be valued similar to the way traditional options are valued. There are three major kinds of real options. First, option to expand, also known as option to scale up or option to switch up. Second one, option to delay or the timing option. Third, option to abandon. Let's understand more facts about the option to expand. Some negative NPV projects might be essential as a startup investments for a bigger opportunities. Thus, they have high NPV in subsequent periods. Traditional DCF will disregard such project completely and will miss out on a big bucks opportunity in the future. In this case, option to expand is valuable. Some of the examples for a scale-up options could be high-tech markets, R&D intensive businesses such as biotech and pharmaceutical, multinational firms, strategic acquisitions, and among switch up options, examples could be small batch and good producers, utilities firms, and farming. Then when we talk about options to delay or the timing options, our examples could be natural resources companies, for example mining, patents, exclusive rights to launch a product, real estate development. This option is about delay investment until more information is acquired or more favorable situation is revealed. So this is a type of wait and access the situation. Or we may say with high uncertainty, marginally positive NPV projects may not be undertaken by managers right away. For example, projects that are sensitive to capital budgeting inputs such as price changes and market demands. So wait and see could be a better strategy as we learn more about their prospects. For example, the option to delay is higher than the current positive NPV. At the same time, a patent-like asset is supposed to be valued as the timing option. Third type is option to abandon. This is a type option where we shut down or shrink or liquidate the projects. Shut down or shrink when liquidation or quitting are more favorable for firm's value. And some of the examples which you can see on the slides could be capital intensive industries, financial services, new product introduction, airframe order cancellations. So projects that are relatively easy to liquidate can be abandoned when a state of nature revealed in its future or not so favorable. You don't have to stuck with it until the end of the project's life. The so-called abandonment option. Looks like there will be implications for this mechanical or traditional DCF analysis. Managers get some flexibilities due to their real estate investments. These new options carry some dollar value, so they need to be adjusted. The traditional DCF analysis based NPV need to be adjusted. So adjusted NPV would equal to traditional NPV plus real option value. Because traditional DCF underestimates NPV of some projects, they ignore the real options. They lead to false rejection of worthy investments that might have added value to the firm. It's also important to know that firms operate in a highly uncertain or dynamic and fiercely competitive environments. So definitely traditional DCF has flaws which ignores the real option value. It will be also interesting to know when is it advantageous or appropriate to apply a real option analysis. First, it can be advantageous when business environment has high uncertainty. Naturally, flexibility comes in handy in the ever-changing settings. More importantly, though, options present a special nature of asymmetric payoffs, since it is rights and not the obligation. That is, you get to exercise your rights of action in upside scenarios while get to do nothing in downside scenarios. With higher uncertainty, the potential gain from exercising your rights is just simply higher, with no suffering from potential loss from downside scenarios, is you're not obliged to do anything there. So one rule to memorize can be that the higher the uncertainty, the higher the option value always. For example, emerging young industries have higher uncertainty, but they can bring higher option value because of their new line of products, unique new line of products, which is patent based or R&D intensive industries, and so on. Other environment could be of competitive industries, especially for the option to expand. Although the advantage might lean towards market leading companies a bit, is they tend to get the first call, lower cost to exercise rights through economies of scale and wider customer base. Third, appropriateness to apply a real option analysis could be in situation when there is a proper management team available with new and open-minded thinking. They also need to understand and clearly identify the embedded real options with ability to really exercise them. For example, centralized versus decentralized. So far we know that the real options valuation is a dynamic approach to valuation in terms of flexibility and growth opportunities. It is an important adjustment to the traditional DCF method. Adjusted NPV equal to NPV traditional plus real option value. But most important to understand is how do we calculate this real option value. For this, you have to first understand the basics of the option pricing that I would cover in our part 2 of the real option analysis lecture series, which span over to 5 parts. Thank you for joining me today.